I want you to think of your business like a game. And this is our game board. We call this the venture board. It's nice and linear, and it takes you where you want to go. And it is a total fantasy of what we wish business could be. A nice, linear path to where you want to go. In reality, this is our realistic venture board. Business is a twisty, complex, joyous, disappointing, unpredictable roller coaster of fun and terror. And sometimes hitch happens. But few great fortunes or accomplishments are achieved without embarking down this odd, winding road. So welcome. For our purposes, we have to use the predictable venture board because it's just clear. But you and I know the truth. At this point, if you're just starting on your journey, you have the same question as just about everybody else. I know what I want to do, but how do I start? The answer is easy. You just start. You don't let fear or naysayers or obstacles get in your way. It's easy for me to say, I know, and it is harder to do, but you do just have to start. I'm going to show you how to start by getting organized. This van, that's our game piece. We're going to come back to it. Now, the first thing you do to get organized is you create a business plan. We cover making your business plan in a different video, but let me give you the bottom line. Your business plan is your best chance to write down what you're going to sell, who you think you're going to sell to, who you're going to need to help you, and how much cash you'll probably need. It doesn't have to be 1,000,000 pages, but it should cover those 4 things. After your business plan, the next step in getting organized is to set up your company. I want you to understand why you need a company and what it does for you. So we're going to start with one of the great inventions in human history, limited liability. And then I'm going to show you the steps in setting up your entity. Hi, I'm Coco Sudek. I've been working with entrepreneurs for the last 20 years as a business lawyer and as a consultant. And I've worked with all kinds of business people, good, bad, great, and some who are horrid. And I'm here today to tell you in this video the fundamentals of setting up an entity, the how and the why. But I got to tell you the bad news. There's no way I can tell you in this video everything that you're going to need to know to set up your entity. First, because it's too complicated. And second, because you need a lawyer. Even pros need a lawyer. I need a lawyer, and I can't be your lawyer. First, because I can't hear you because I'm talking to you through a screen. Second, because I don't take clients from these videos. Because if I did, I would worry that you would think I was holding something back just to get you in the door. And I wouldn't do that, and I'm not. So you're going to have to find a lawyer who can really help you. Now, if you go to my website at profitandlaws.com/lawyers, I might have some resources there to help you. I get no money from that. I won't take any referral fees. But I think that if I tell you to get a lawyer, then it's up to me to really help you get started in finding a lawyer. Being a business lawyer is an honor. But having a great business lawyer is a necessity. Now let's get started. So let's start here. Let's say you buy a van, and that's your business. How are you going to own and operate the van? Will you go down the street to the van store and just buy it? Or will you first set up an entity, put the van purchase price in the entity, and have the entity buy the van? The best thing for you to do is to create an entity and drop your business inside it. See, here's the van inside the entity. An entity is really just a make-believe invisible box that you create in partnership with the government. That's all it is. And that box, that entity, it limits your liability to just what you've invested in the company. That's why it's called limited liability. That box may be invisible and make-believe, but it keeps you safe from the dangers of your business because it protects your personal assets from your business liabilities. Look at the difference between using an entity with limited liability and without. If you buy your van without an entity, like on the left, then everything you own is at risk from bad things that happen with your van. Because everything you own, including your van, is inside the circle of you. So if you get in an accident and have lots of debts as a result, those debts can wipe out your house, your car, your van, and you. But if you set up an entity and have your entity buy your van, like on the right, then any debts that result from your van stay safely inside your entity, away from the circle of you. It seems strange, right, that you could stay safe inside an imaginary box. But let me explain it to you. Limited liability has a really technical sound, but limited liability is the reason why America became America. See, in the 1800s, we started to do big things. We started building these big factories that could churn out all kinds of textiles and other machinery and stuff like that. The problem is, those were dangerous places. And so, if an investor put any money into that business, that investor was on the hook for any liabilities, right? And bad things happened. So people would be ruined by investing in those companies. So they wouldn't. So then the factories, these big, great businesses, they started having a hard time raising money. So a bunch of state government people and business people got together and said, well, wait a second. What if we made it so that if you invest in a company, the only thing you've got at risk is what you've invested? That's limited liability. So now the factories and the big companies, they started to get funding. They started to actually grow, and they built the cities, and America became America. But what those governments were saying to people was this: if you start a business and you keep it separate from the rest of your life, and you act reasonably honestly, we won't make you liable for the debts of your business. And that idea, that limited liability, has encouraged all kinds of people to start businesses and take risks. And that's the story of business and America. And that's the importance of limited liability. But look, limited liability, it's a bargain. It's not an entitlement or a right. It's a handshake. It's a deal that you make with all of us. You see, we really, really want you to start that business. And to start that business, we know that you need to be safe from liability so that you can take risks. But we need to know when you're doing business behind that shield, and we need you to not use your entity to get away with murder. So there are 5 things that you got to do as part of this bargain to really lock down limited liability. Here's what they are. First, you have to set up your company, your entity, with a government by filing sort of an application for an entity birth certificate with a state. The second thing you got to do is you got to capitalize your business. You actually have to buy stock in your own company with cash money. And you got to not take too much money out of the company for yourself so that your creditors can't get paid. The third thing you got to do is you got to keep everything separate, right? You got to keep your entity separate from your personal stuff, from your personal expenses and assets. And you got to do a little company housekeeping every once in a while. You got to write down some of the things that your entity does. Fourth, you've got to be fair and nearly honest. You don't have to be perfect, but you can't be malicious. And fifth, you've got to show your shield. You've got to use Inc. or LLC or LTD in your entity name because you're showing the world that you're doing business behind a shield. And those are the 5 things you've got to do to lock down limited liability. But look, it also means that limited liability only goes so far. Limited liability will not protect you from crimes you commit or people who sell the company assets for a bargain and fail to keep enough money around to pay creditors. Or people who treat the company as their alter ego by using company bank accounts as their personal bank accounts. Or sexual harassment. Or securities violations. Or failure to pay your employees withholding to the IRS. That happens a lot more than you'd think, by the way. Or failure to pay wages to employees in some states. Or fraud or environmental liability. See, there are all kinds of exceptions to the limited liability rule. And people who do these things could lose their house and their car and everything else, even if they did these bad things through their entity. Setting up an entity is the right thing to do, even though, I'm not going to lie to you, it is a huge pain in the ass. You got to pay some money in the beginning to set the whole thing up, and then every year you got to deal with banks and taxes and accounting and a little company housekeeping. But it's still the right thing to do, because it gives you limited liability. It makes you look serious and for real to the rest of the world. And it might make you pay more formal attention to your business than if you didn't do anything to create it. But there's one more reason why you should set your entity up in the beginning of your business. Because if you're going to build your business, you want no mistake that all of the business's assets belong to the business and not anyone else. Contracts, trademarks, money, and assets, they all should be owned by the business, and there should be no mistake among anyone who owns, partners with, or helps the business get going. Let's take a detour for a second. I want to show you the structure of an entity so that you can start to understand how an entity is built and run. This is how an entity is generally structured. The entity is owned by owners. Owners elect policymakers. Policymakers set policy and hire and supervise officers. Policymakers, by the way, also decide whether the owners are going to receive a share of the profits of the company. When profits are shared with the owners, it's called a dividend or a distribution. And it's always the decision of the policymakers. Now, officers and employees run the day-to-day of the company. So that's the basic structure. Now, I'd like to tell you a story about a business person who did all the wrong things with this entity and paid the price for it. This is a war story. We use war stories to show you real-life examples of people who went to battle over rules, contracts, and bad deals. This is one of my favorite of all war stories because it plays into everyone's fear when they go to hire a contractor to work on their house. So let me tell you about the Fontanas. A nice family from the suburbs of Chicago that hired a contractor for $1.5 million to build them a home. The contractor took the money and then never finished the house. Exactly what you'd fear would happen with a contractor. But the Fontanas sued and the Fontanas won. But that's not the war, because when the Fontanas went to collect the money, the contractor was broke. And Nick, the guy they thought they hired, the guy that they had heard so many good things about, he turned out not to even be an owner of the company. So the company was broke, and the guy they thought ran the company wasn't actually the owner. And it started to smell because Nick, he seemed rich. So they looked into it, and then they figured out what was going on. Because Nick wasn't the owner of the company. His wife was, a woman they had never heard about and never met. So they sued again, and they put her on the stand and asked her a bunch of questions, and she admitted a bunch of things, most of them embarrassing. Nick's wife admitted on the stand that she never paid for her stock. As a matter of fact, nobody ever paid for her stock because they never put any money in the company. Second, the company actually paid their personal bills, so there was no separation. Third, they didn't keep any corporate records. There were no company records for the company. Fourth, she wasn't really in charge of the company. Nick lied. She didn't know how the company made money or spent money. And fifth, they didn't even bother to use their corporate name. So the winner of the war was the Fontanas, because Nick and his wife had to pay the Fontanas out of their own pocket, because the judge sliced right through that fake entity to get right to them, pierced through their limited liability shield. The moral of the story is respect the separateness of your company and don't be a fink. I hope you understand limited liability and why it's so important as you set up your company. So let's talk about how you set that entity up. There are 5 steps to setting up your company. You pick your tax treatment, you pick your entity, you pick a state, pick a name, and then you file. Let's start with tax treatment. Governments charge taxes on business profits. Who has to pay those taxes is called tax treatment. And there are 2 flavors of tax treatment. There's corporate and there's pass-through. Now, if you're still with me, I'm going to make this clear. Companies with pass-through tax treatment don't pay taxes on the profits. The owners of those companies pay taxes on the profits, as if those owners made the money themselves. Now, the upside to this is that if the company has a loss for the year, the owners might be able to use that loss to offset some of the taxes they might pay from other sources of income. I realize this gets confusing. So let me show you a very brief description, a little diagram of how this all works. A company that has pass-through tax treatment passes its income and its losses through its owners. And the owners pay taxes on the income of the company. In contrast, companies with corporate tax treatment pay taxes on their profits directly to the government, and they file their own tax returns. When they later issue cash to their shareholders, to their owners, in the form of a dividend, the owners have to pay tax on that again as income to them. That's called double taxation, and people hate double taxation. Also, the owners can't take credit for the company's losses on their own tax returns. I know this is also confusing, so let me show you a diagram. A company that has corporate tax treatment pays taxes on its own profits and files its own tax return. When the company sends cash to its owners in the form of a dividend, the owners pay tax on it again. That's called double taxation. Double taxation is a very unpopular feature of corporations, and losses cannot be used by owners to offset their tax on other income. Which tax treatment is right for you depends on a whole bunch of factors, which is another reason why you really need a lawyer and an accountant. Once you pick your tax treatment, you can pick your entity. There are many kinds of business entities. Here, we show you just 11. But even though there are 11 here, we can whittle them down quickly to just a few. First, we can get rid of the ones on the left. Those are the ones where you just start. You don't have to do anything. You don't file any papers with the state. And so all of your business and personal everythings are locked into the circle of you. I don't like these entities. I don't recommend these entities. They're not really entities, so we can get rid of them. Now, I'm only going to focus on the top 3, but first I'm going to tell you why I'm not going to talk about the others. Let's start from the bottom up, just to mix it up a little bit. So trusts get used for sophisticated asset and liability management schemes, but not for startups, so who cares? Limited liability partnerships are usually used for like lawyers, accountants, engineers, professional companies. L3C and benefit corporations are these newfangled entities for people who focus on mission more than profit. They're relatively untested, so I'm a little wary, and so are a lot of tax lawyers. So I'm not going to talk about them here, although I might talk about them in a future video. Not-for-profit corporations, those are for not-for-profit entities. I'm not going to cover these today, but I may in the future because so many people ask for them. And then we have the top choices, the ones we're going to talk about. The C corporation, the S corporation, and the limited liability company. Now remember a few minutes ago, we talked about corporate versus pass-through tax treatment. Corporate tax treatment is on the left, and pass-through tax treatment entities are on the right. C corporations have corporate tax treatment just by default. S corporations and limited liability companies have pass-through tax treatment. So let's take a deeper look at how entities work. Let's revisit the slide we saw before. Remember, the basic structural pillars of every entity are relatively identical and simple. The entity is owned by owners. Owners elect policymakers, and policymakers hire and supervise officers and employees. Officers and employees run the company. That's the basic structure. In corporations and LLCs, the structure is the same, but the names differ. So let's look at those 3 entities. Okay, we're going to start with corporations, because corporations are the workhorse of business entities. They've been around so long that the law is so well developed, and so are the documents. It's incredibly easy to set up a corporation. And here's how corporations work. The corporations are owned by stockholders. Stockholders are also called shareholders, just to mess with you. Stockholders elect directors, and directors hire and supervise officers and employees. Even though you see many owners and directors, corporations can almost everywhere have just one owner and one director, and it's pretty common to do that. So now here's where it gets tricky. A corporation can be either a C corporation or an S corporation. If you just set up a corporation, you would have a C corporation. An S corporation is a C corporation whose owners have asked to be taxed with pass-through tax treatment. See, an S corp is really just a C corp that's been converted to a special kind of pass-through tax treatment. Now, the S corp was created to help American small business. As a result, the tax man has lots of rules about what you can and can't do with an S corp. So, for instance, no business can own shares in an S corp. Only people, estates, and some trusts can own shares in an S corp. So if you want to get funding from like a venture capital firm or a professional investor who want to buy the stock through their company, you can't be an S Corp. S Corps can't have more than one class of stock. S Corps can't have more than 100 owners. That's a biggie. Remember, S Corps were created to help small business. So presumably, if you have more than 100 owners, you're no longer a small business. There are also limits to what the S corporation can do. For instance, S corporations can't be internationally based. They can't be a financial institution, and they can't be an insurance company. So let's look at the LLC. The LLC is the limited liability company. And it is a combination of everything we know about entities. The LLC only came along about 20 years ago. LLCs have limited liability, pass-through tax treatment, and they're tremendously flexible. Now here's how the LLC works. Owners are called members. Now stay with me. LLCs can be managed by members or managers. And you get to pick. If the LLC is manager managed, then members elect managers like shareholders of a corporation elect directors. Managers or members, if the company is managed by members, hire and supervise employees, and employees run the company with the managers. Because the LLC is so flexible, you can set the LLC up to look like any other entity. It really is sort of a miraculous little invention. Now, like corporations, LLCs can often be owned by just one person, but there are some states that don't allow one person to own an LLC. So if you're going to start an LLC by yourself, you just want to check your state laws. Now, LLCs have some drawbacks. LLCs are governed by partnership tax law, which is horrible. Also, LLCs are not yet desirable on the IPO market. And since they're really only about 20 years old, there's not a lot of law out there to help you figure out the rules and the laws around LLCs. And LLCs can have a higher filing fee in the beginning, which can matter to a startup that's hungry for cash. The obvious question that you want to know is, which entity should I pick? And the answer is, I don't know. But let me explain why. First of all, it is an incredibly complicated question, and it really depends on things unique to you that I can't know. So I can't tell you. But second, if you go to a corporate lawyer and a tax lawyer and an accountant and a financial advisor and you ask them the question, you're going to get different answers from them because nobody really agrees. So even though I can't tell you which entity you should pick, I can tell you what I think about when I'm picking an entity for somebody else. Okay, first, I start with the idea that in 2015, an LLC is a very safe choice. It's flexible, it's got limited liability, and you can always change it if it's not the right entity without too much hassle. The LLC does have some drawbacks. It's a little bit more expensive to set up, and if you want to go get money from VCs or professional investors, they usually don't like an LLC, so it might be the wrong choice. Then there are S Corps, the S Corporation. I like the S Corporation, particularly for companies where there are just a few owners and they all work in the business. Now, if that company is going to get big and it's going to have a lot of owners, the S Corp isn't the right vehicle. But in the beginning, it might be. Profit and Laws is an S Corp. I'm a big fan. Okay, third, there's the corporation. The corporation is the workhorse of entities. It's really dependable and reliable. It's got limited liability, and it's relatively predictable in terms of how to structure it. It's also really, really good for companies that are going to have a lot of employees who are going to get stock options and companies that are going to go and raise money from VCs or other professional investors. So that's how I think of these entities. But I really encourage you to talk to a lawyer and talk to an accountant to get guidance about picking the right entity for you. After you pick your entity, you next have to pick your state. Remember that you get limited liability because you file your application for an entity birth certificate with a state government. Now, a lot of people recommend you just organize in Delaware. And Delaware is a fantastic state. It's got terrific laws, it's got terrific courts, it's got great procedures, and it's really a top-notch state for organizing a company. But here's the thing. If you're going to organize in Delaware, but you're going to operate the business somewhere else, you're going to have to not only file that entity birth certificate in Delaware, but you're also going to have to file it in the state where you actually run the business. So all you've done is duplicate your filings. So you can just focus your filings on the state where you're going to run the business. And later, if you're going to be a company that's going to do business in many states at the same time, or you're going to go public, you can always switch to Delaware later. After you pick your state, you get to pick your name. Now, the name you pick must not match an existing entity name on the records of the state where you're organized. They just can't be identical. You can tell if your name is available by going to the Secretary of State's website in your state and searching the names of other business entities for the name you want. Now, this is the search box for the state of Illinois where people search for names they want for their entities. If you get something identical or close to the name, you may have to pick another name. And even if you get a name that is available, that's not like something else, picking that name may be a trademark problem. So 2 things. Tread carefully and pick up a copy of Birth to Buyout, Law for the Life Cycle of Your Business to learn more about trademarks, or get our Understanding IP video. All right, so now you've got your name and your state. It's time to start all the filings. The big task is to fill out an application for an entity birth certificate. These are pre-printed forms with the Secretary of State in your state. In many states, you also might be able to set your company up online. The application has different names depending on the entity choice. For a corporation, it's called an Articles of Incorporation. This document on the screen is an Articles of Incorporation from the state of Illinois. For an LLC, it's called Articles of Organization. There are lots of options for you to file your entity. You can do it yourself. You can hire an electro lawyer like Rocket Lawyer, Nolo, LegalZoom, Biz Filings. I don't work for any of them, so I don't know if they're any good. I'm just giving you examples. You can hire an actual human lawyer who works in a small firm or maybe in his or her own firm. Or you can come to a great big international law firm. So let's take a look at those options. Which one is right for you seriously depends on you. Doing it yourself is cheapest today, but you'll pay in the long run when you have to have it redone. It's hard to set up a new company for yourself, even for pros. I really don't recommend you do it yourself. Electro lawyers are built to be affordable, but you might get minimal guidance. My favorite choice for new companies are solo or small firms because they're better priced and they have lawyers that actually represent and talk to you. It may be hard to find good ones. I do recommend that if you hire a lawyer who works in a small or a solo firm, that you make sure that lawyer has been mentored by an experienced lawyer so they learn something. Because when we come out of law school, we don't know anything and somebody needs to teach us. That's my little 2 cents about picking a lawyer. Finally, you can also come to a big firm. I'm in a big firm. Big firms do a very complete job, but boy, are we expensive. You may not need all that firepower in the beginning. So for you, my favorite choice is still probably a solo or a small firm. If you'd like help finding lawyers, go to my website, profitandlaws.com/lawyers, and we may have some resources to help you. We get no money for this. I just believe that if I'm going to tell you 8 times to get a lawyer, I ought to give you some tools to find one. By the way, you're going to have to pay a filing fee with your application for your entity birth certificate. The amount of the filing fee should be written on the document, so make sure to budget both for lawyer fees and filing fees, because those filing fees are non-negotiable. On the screen are fees in Illinois, just to give you an example, but the fees vary from state to state, so you got to check your state's fees. Once you have your Articles of Incorporation or Articles of Organization filed and accepted, you have created your new entity. You should get back your company birth certificate soon after you file. On the screen is a picture of a certificate of incorporation from the state of Michigan. Okay, but here's the bad news. Once your entity is created, there are more government filings to make at the federal, state, and local level. Now, some of these 10 filings may not apply to you, but I want to mention them anyway, just so that you know them. First, when you get your birth certificate back from the state, you may need to register that in the city or the county where you're running your business. You might also need to take out an ad in a local newspaper to alert the world that you've set up this entity and you're doing business behind a shield. And if you're going to do business in more than one state, you might need to register in that state, actually get permission to do business in that state by filing an application for a certificate of authority. Next, the tax filings. So let's start with federal. When you get your entity birth certificate back, you got to get a tax identification number from the federal government. This is like your entity's social security number. You go to irs.gov, fill out SS4, and you get your FEIN. Follow the instructions. FEIN is another name for the tax identification number. It stands for Federal Employer Identification Number. Next, if you're going to be an S corporation, you got to file your S election with the IRS. You only have 2.5 months to do it, so make sure you make the deadline. Do that on Form 2553. Okay, we're almost at the end. Next, you've got state tax filings. So most states will require companies operating in their borders to register and pay income tax on their business profits and also collect and pay sales tax on sales of things. So you might have to register with the Department of Revenues of states where you operate. Second, there will probably be some unemployment insurance obligations and some workers' compensation obligations. So you want to register with whichever agencies in your states handle that and then buy the insurance that they require. Finally, there might be licenses that you need to operate your business. For instance, you'll probably need a business license to operate your business in the city or county, wherever you are. But there also might be some licenses that you need just to perform the services you want to perform. Like hairdressers need a license, lawyers need a license, all kinds of different businesses who you'd never expect need a license, and you have to figure out what those are so that you don't run afoul of the law. So talk to a lawyer who can really help you with the laws in your area. Finally, you got to get organized internally. Grab that entity birth certificate that you just got back from this state, your certificate, and put that aside. Next, you have to create stock records, ownership records of your company. So remember, you have to buy stock or interest in your company. So you want to do that. You want to actually pay real cash for it. You want to write that down. If you've got a corporation, you have to issue stock certificates to the people who buy stock in the company. You don't have to do that for an LLC, but it's a nice practice. Make a copy of those stock certificates. Most importantly, create a stock register. That's a table listing everybody who owns stock in your company, how much they own, what they paid for it, and when. Keep that stock register up to date. It's incredibly important. Take all those stock records, put them aside. Next, you have to create minutes and resolutions. Now, this is where it gets a little complicated. So, actions of the shareholders and the directors are called resolutions, and records of those resolutions in a meeting are called minutes. You don't have to remember any of that. What you do have to remember is that your shareholders and your directors are going to have to do certain things. Buy stock, sell stock, elect directors, all kinds of things, and approve major transactions. You want to write all that stuff down, everything that they did, and you want to do it every year. And then you take those documents and you put them aside. Next, because your entity is special and separate, it has to have rules for how you're going to govern it internally. Those rules are called bylaws for a corporation, and they're called an operating agreement or a company agreement for an LLC. You need to make those. Get a form from someone, tailor it the way you like, and put those aside. Finally, all those tax filings that you made with any kind of state tax or federal tax agency, you should get receipts for that stuff. Take all those receipts and put those aside. Okay, now here's the showstopper. You grab all those documents that you put aside and you put them in a big book that looks like this. This is a minute book. This is your entity's baby book. This is the book that wraps up everything fundamental about your company and preserves it for posterity and also so that you can look back on it and figure things out. You make this book, you keep it up to date, and if there's a fire, you grab that book first. You may hopefully appreciate having a well-organized and up-to-date minute book, but you will really regret not having one. Ta-da! Mazel tov!